I'm going to discuss some of the key provisions of the proposals, rather, some key proposals of this budget 2024. I will focus on some of the important provisions only instead of doing a threadbare analysis of all the amendments. To start with, I will discuss about the proposals with respect to direct taxes. In the direct tax provision, I think the first thing which I would like to discuss is omission of clause 6B in subsection 2 of section 56. This is something which is quite puzzling as to this provision was introduced in 2012 to take care of the menace of adjustment which was happening by way of introduction of capital, wherein suppose in a private limited company, which is not a listed company, where suppose the value of the share is only 10 and there is not much of business activity in the company. So there is no justification for issue of share at a premium. But prior to 2012, there was no provision for issuance of share, whether at a face value or at a premium with respect to a private limited company. So many a times the companies were issuing shares at quite a high premium. So the company, which is a new company, which has no business existence and no such prospect also, business prospect also, used to issue share with a premium of say 90 rupees or even 990 rupees. So in order to take care of such a menace, this provision was introduced in 2012, whereby if a company is issuing share for a price which is more than the fair market value of the share, then it will be taxable under the head of income from other source. But inexplicably, I mean, in the memorandum explaining the budget proposals, I was trying to figure out if any reason has been given for introduction of this provision, because many of the provisions are explained in that memorandum explaining the amendment to the budget proposal. But I don't find any reasoning given in the budget. But the fact of the matter is that with effect from assessment year 2025-26, this provision has been done away with. So now a company is free to issue, a private limited company is free to issue a share at a price it deems fit. So this is the provision which puzzles me. Maybe the viewers may have the answer, and I would like to have the comment of the participants in my comment box regarding the reason which they feel which caused the government to make this amendment. Second provision again is quite a flip-flop with respect to the uncertainty with respect to the amendment which the government does from time to time. In 2021, a wholesale amendment was made with respect to not only provision relating to the reassessment, the time limit for issuance of the notice under section 148, but the block assessment provision, which was there with respect to the initiation of the assessment pursuant to a search and seizure operation, was done away with, and individual assessment for all the years were supposed to be done. Prior to 1/4/2021, let me tell you that for the reassessment, there were two time limits: 4 years if the escaped income is less than 1 lakh rupees, and 6 years if the escaped income is more than 1 lakh. But with effect from 1/4/2021, this time limit was reduced to 3 years if the escaped income is less than 50 lakh rupees, and it was extended up to 10 years if the time limit is, if the escaped income is more than 50 lakh rupees. And simultaneously, the block assessment, wherein if in pursuant to any search and seizure operation and any unescaped income is unearthed, then the 153A provided that 6 years, for the period up to the 6 years prior to the initiation of the search proceedings, a block assessment can be done. Instead of a assessment for individual years, a block assessment for 6 years could have been done under section 153A. But this was done away with. So consequently, it led to a lot of litigation with respect to the limitation period and all that. and the power to initiate assessment, because each year were counted separately, and this was causing a lot of litigation in the high courts particularly. If you see the reported judgment of last 3 years, most of the litigation revolves around the notices issued under section 148A or 148. So now again the government has gone back to the old provision of block assessment for 6 years preceding the previous in which the search was initiated. And of course, it will also include the period starting from the first April of the previous year in which the search is initiated, and ending on the date of execution of the last of the authorization for search or the date of requisition. So this is a very significant amendment. And the tax charged in respect of the block assessment will be 60%, and penalty will be 50% of the tax payable. But no such penalty will be leviable if the SSE offers undisclosed income in the return furnished in pursuant to the research and pays the tax along with the return. So if the return is furnished and the tax is also paid in pursuance to the search operation, then penalty of that 50% of the tax will not be payable. And there is a time limit also for completion of the block assessment of a search SSE, that is 12 months from the end of the month in which the last of the authorization for search is executed or made. Simultaneously, important amendments have been made with respect to reassessment proceeding also. Section 148, capital A has been amended. Section 148A was also introduced with effect from 1/4/2021, where an assessing officer was supposed to issue a notice before issuance of notice under 148. And an opportunity of hearing was to be given to the SSE to show cause as to why a notice under 148 should not be issued. But this 148A did not explicitly say whether with the notice to show cause, it should be accompanied by the information which is in the possession of the assessing officer to come to the conclusion that a reassessment is necessary, or the information which is within his domain for forming the reason to believe for initiation of the reassessment. So now, along with the show cause notice, it is now mandatory that the notice under section 148A should be accompanied by the information which suggests that the income chargeable to tax has escaped assessment in his case. So now not only notice has to be issued, but it is mandatory said it should be accompanied with the information which is in possession of the concerned officer, which gives him the reason to believe that there is an escapement of income. At the same time, now 149 has also been amendment. The manner in which the 149 was drafted subsequent to 1/4/2021, there were a number of provisos which led to numerous litigations with respect to whether the time limit of issuance of notice under 148 has expired or not, or whether notice under 148A and whether 148 is synonymous with each other. So in order to avoid litigation in this respect, now 149 provides that no notice under 148A shall be issued if 3 years have elapsed. So for issuance of notice under section 148A, time limit of 3 years has been given. And this time limit is there if the escaped income is not exceeding 50 lakh rupees. And for issuance of notice under 148, the time limit is 3 years, 3 months. So the time limit has been simplified. So it is 3 years for 148A notice if the escaped income is less than 50 lakh. And for issuance of 148 notice, it is 3 years, 3 months. Similarly, for notice to be issued beyond a escaped income of 50 lakh rupees, the time limit was 10 years. Now this 10 years has been drastically reduced to 5 years. So for a 148A notice, the time limit if the escaped income exceeds 50 lakh rupees is 5 years. And for notice under 148, if the escaped income is more than 50 lakh rupees, is 5 years, 3 months. So this is the time limit which has been revised under 149, and hopefully the litigation with respect to the time limit issue under 148A or 148 will be reduced, and both the SEC and the department will benefit. Again, the time limit for filing of the appeal before income tax tribunal has been revised. Till now, the time limit was 60 days from the date of the communication of the order to the SEC. But now since the communication is taking place over the portal, so this time limit has again been revised to 2 months from the end of the month in which the order sought to be appealed against is communicated to the SSC. So the time limit has been enhanced. So if suppose the order is passed on 1st of a month, then the SSC has almost 3 months to file the appeal. And if it is filed on the last day of the month, then he only has 2 months. Now, in this budget, I believe one of the most talked about amendment is with respect to capital gain. And by now we all know as to what are the amendments in with respect to capital gain. But nevertheless, I just briefly go through it that now, unlike earlier, the time limit was 1 year and 3 year for computation of the for determining whether it is a short-term capital gain or long-term capital gain. Now it is 12 months and 24 months. And the rate of tax has been increased from 15% to 20% for short-term capital gain on equity shares. And for long-term capital gain, it has been raised from 10% to 12.5% for listed equity shares. And for other assets, earlier the rate of tax was 20% with indexation benefit. Now the indexation benefit has been taken away and the rate of tax has been reduced to 12%, 12.5%. Now, in some cases, it will be beneficial. In some cases, it will go against the SSC, but it will all depend on how much the value has been added, what is the cost of acquisition. So it's all a matter of mathematics. And it cannot be said either this way or one way or the other that this particular provision will uniformly benefit all the SSCs or whether it will be disadvantageous to all the SSC. So it will depend on it will vary from fact to fact. For some SSCs, it will benefit. For some SSCs, it will be disadvantageous. Now, another thing is that this proposal has been made immediately applicable with effect from 23rd of July 2024. With respect to one provision, immediately after the budget, the finance minister and the revenue secretary clarified that this indexation benefit has not been done away with respect to property acquired prior to 1/4/2001. Now, for properties acquired prior to 2001, the law says that the SSC has the option to determine the cost of acquisition as either actual cost or the fair market value as on 1/4/2001. Now, I could not find anywhere from the fine print whether this benefit of indexation has been retained for properties acquired prior to 1/4/2001. This is something missing from section 55 as well as amendment in section 48. So, if any of my friend can enlighten me as to under which section this benefit of indexation for properties acquired prior to 1/4/2001 has been extended, I'll be grateful, because from the fine print, I could not find anywhere that this has been extended, even though the finance minister had said so, that for properties acquired prior to 1/4/2001, the benefit of indexation is still available. Now, the last amendment with respect to the income tax provision is an amendment in section 194C. There was no clarity whether, suppose if any engineer has entered into a contractual agreement, then whether it will be treated as a works contract and 194C will be applicable or 194J will be applicable. Similarly, there used to be litigation around, suppose somebody does work according to somebody's specification. It can be a job work or it can be a manufacturing according to the specification of your customer, but the material is not purchased, material is not supplied by the customer. So it is not a job work, but it's a manufacturing according to specification by the customer. There used to be a dispute around this issue also, whether it falls within the purview of 194C. So two explanations have been added. One is that if one is manufacturing or supplying according to the requirement or specification of a customer, but the material is not purchased from him or any of his associates, then it will not fall within the purview of the deduction under 194C. And in fact, no TDS is required to be deducted because it is a sale of goods. It is a transaction of supply of goods. Second explanation which has been inserted in 194C is that if any sum is referred to in section 194J, so if any income, if any amount is paid to a professional defined under 194J, for example, if a payment is made to an engineer, so even if he is executing a works contract, the 194J will apply and 194C will not apply. Now, another last one, which I would like to discuss in the Income Tax Act is that many people whose main source of income is rental income, they buy various properties and put it on rent. They used to disclose the income under the profit and gains of business and profession instead of reporting the income in the income from house property. So now an amendment has been done that if any income from letting out of a residential house is earned, I'm not talking of the commercial property. If any income from letting out of residential house is there, then the income under no circumstance can be charged under profit and gains of business and profession, and it will necessarily be chargeable under that income from house property. Now, I will quickly take you through two amendments, which are the sort of, sister law of Income Tax Act, that is Black Money Act and Benami Property Act. One of the amendment in Black Money Act is that if a resident fails to report any asset or income located outside India, then it was liable for penalty within the purview of Black Money Act. But now it has been proposed that if the asset is not an immovable property, and where the aggregate value of such asset does not exceed 20 lakh rupees, then this penal provisions will not apply. Another very significant amendment which has been done in Benami Property Transaction Act is insertion of new section 55 capital A. Till now, if any Benami property or Benami transaction is caught, then the Benamidar as well as the beneficial owner, that means the Benamidar is the person who holds the property for the beneficial use of a third person who is the actual owner. So the beneficial owner is the person who provides the consideration and holds the property in the name of a Benamidar. But till now, the penal provisions applied equally to the Benamidar as well as the beneficial owner. And it attracted a penalty of rigorous imprisonment for minimum of 1 year but up to 7 years, and with fine extending up to 25% of the fair market value of the Benami property. Now, this affected many poor and illiterate people. For example, a high net worth individual, they hold property in the name of their domestic staff, their drivers, their peon, to avoid Income Tax Act, mainly to avoid income tax, rigors of income tax law. Because there are clubbing provision in the income tax law, so they don't hold the property in the name of their immediate family member, which may attract clubbing provision. And also, it affected the information provided by the Benamidars. So even if some incentive is given by the government, they would not come forward because they will equally be penalized. Now we know that including the criminal laws and the various other laws provides for tender of pardon or immunity from prosecution or reduced penalty in cases where the witness assists in the due process of law. That means he becomes the approver. So similar provision has been introduced by introduction of section 55A, wherein it has been provided that if a Benamida comes forward and provides information to the officer under the Benami Property Act, then he can be given immunization from penalty on condition of his making a full and true disclosure of the whole circumstances relating to Benami transaction. And a tender of immunity made to or accepted by the person shall extend to which the immunity extend, which will render him immune from prosecution of any offense relating to Benami Property Act. But it is also proposed that if he fails to provide the full information, and he willingly conceals anything or gives false evidence, then that immunity will be withdrawn. So with this, I conclude my discussion with respect to direct tax amendments. Within the purview of the indirect taxes, I'll only discuss 2 or 3 amendments, which I believe are crucial amendments. One is insertion of section 11 capital A. This section empowers the government to regularize non-levy or short levy or non-payment of tax due to any general practice prevalent in the trade. There are many instances where, due to a particular interpretation of the law, there are disputes with respect to the rate of tax, classification dispute, or availability of the input tax credit, and things like that. Now, if the practice is general in nature, where almost all the trading community or say the members of that particular trade are following that practice, whether even if it is not correct as per the or matches with the interpretation of the government, then the government is now empowered to regularize that non-payment and issue a notification with that respect. So this is a very important amendment according to me. Second amendment is with respect to insertion of subsection 5 and subsection 6 in section 16. There are a lot of disputes across the country with respect to belated filing of the return beyond the due date prescribed in section 16(4). Now, in order to regularize the denial of the input tax credit for financial years from 2017-18 to 2021, the credit is the subsection 5 has been inserted, which says that if a SSC has taken input tax credit in any return filed up to 30th day of November 2021, then ITC cannot be denied. Now, subsection 6 is also inserted, where if suppose somebody's registration is cancelled, then on revocation of the cancellation of the registration, the time limit for availment of input tax credit shall be extended, and the tax credit shall be available if the return is filed within 30 days of the revocation of the cancellation of registration. Now, with this, the another unfortunate, rather I would say, or unconstitutional amendment is that if any SSC has already paid the tax or reversed the input tax credit because of a demand under section 16 subsection 4, then the refund will not be admissible. This is really unfortunate, and I think this is a very harsh provision, because if somebody, because the similarly situated SSCs are being treated dissimilarly. So this is a very unfortunate amendment. So I think this needs to be taken care of. And I think this will only be resolved by the High Courts or the Supreme Court. Already there are SLPs and writ petition pending before the Honorable Supreme Court, and hopefully the Honorable Supreme Court will resolve this particular issue with respect to those SSC which have already paid the tax, but to them no refund will be admissible. And the last provision which I would like to discuss with the purview of the GST law is insertion of section 74 capital A from financial year 2024-25. So from 2024-25, section 73 and 74 will be applicable for any demand up to 2023-24 only, financial year 2024. There is no concept of assessment year in GST law. So up to financial year 2023-24, section 73, which applies for non-payment of tax or excess availment of input tax credit for a reason other than fraud or willful misstatement, applies, and section 74 applies to those cases where the tax is not paid or excess ITC is availed due to fraud or willful misstatement. So there is separate time limit for issuance of notice under section 73 and 74. Now it has been merged into section 74A, and the time limit is 42 months from the date of the filing of the annual return. So irrespective of the fact whether there is any fraudulent intent or not, the time limit is same. So whether you are a fraudster or whether you have committed a genuine mistake with no intent to evade the law, the time limit is 42 months from the date of the filing of the annual return. So friends, with this, I conclude my today's session. Thank you very much.